I mean, currently we have, close to 500,000 jobs that they cannot fill in technology in the country. And so I'm just curious as to, the level of funding into this workforce development fund and if it's actually producing results. So I'm happy to have anybody out there that wants to answer that question for me. I'm happy to let them get that information for me, because what's my trade-off here is what I'm looking at is we've got 6.78% of these corporate income taxes that are going to this fund. That's not going to other programs. So I'm happy to have anybody respond to that, because workforce is constantly something we hear about. Is that correct? Can you confirm that? Or?
Absolutely. You can count on really three types of questions that businesses are going to ask. One is going to be about available buildings and sites. I mean, they have to have a place where they can actually create the jobs and the employment. The second is workforce, not only the availability, but the skill level of the workforce. In particular industries, they're looking for ways that they can augment the skills of the workforce. And that goes across all sectors. Every single industry that we deal with has workforce issues, and of course the third factor is going to be the business cost and input, which is directly related to workforce. If you have to spend significant amounts of money training and retraining because of attrition and turnover, because of unskilled workforce, and possibly poor quality products that have to be remanufactured, workforce becomes, it's more than just a labor issue, it's a business input and cost skills level. And as you may be aware, our director, Mr. Preston, is working closely with the other workforce providers through the governor's workforce cabinet to come up with some results-oriented issues and programs by which we can provide that pipeline. But our data does show that. I don't know that we could match 500,000 in technology, but our director of existing business resources division, every time they go out and visit with the existing industry, whether they're large, small, rural, urban, high-tech, low-tech, mid-tech, skilled workforce, folks that have the skills, those that can pass drug tests, those who can show up for work, those who can follow directions, those who can read rulers and tape measures, are skills that are lacking. And like I said, Mr. Preston can probably address that a little bit further tomorrow, but workforce is always a top three issue in every project we work.
Well, I thank you for that, because what I see is we're taking a corporate income tax and we're saying, okay, we're going to help you, we're going to help get the workers if we'll tax you, and then you let us develop these workers for you. That's not happening. So what they're doing is they are also having to now train their own workforce. So they're paying a tax for us to do it, but it's not happening, so they're having to do it themselves. That doesn't make any sense to me. So, thank you.
Senator Elliott, direct answer question.
Thank you, Mr. Chair. Speaking of trade-offs and what's important to businesses, do you happen to know the list of states that you read off, that lowered their taxes? Do you know if there's any kind of trade-off, any thought being given to the taxes are lower here, you will still expect the many times very huge incentives that businesses want? Do you have any thought that you know anything about whether or not the request for these incentives are mitigated any by the tax structure being, the taxes being lowered? Or is it still the expectation of getting these big incentives?
I think when you look at a company's business decision, and the key foods did allude to this, it's very complex, and it's like a chemistry equation. If you were to add all of the variables together, you're going to have different coefficients, you're going to have different weights. We make these very competitive, for example, in labor costs and workers' compensation costs, but we're very uncompetitive in, say, sales and use tax. When we look at the bottom line that the company presents to us on what the business costs are going to be, we might be able to meet some of the variable needs that are there. We might be able to guarantee a workforce that's a little cheaper. We might have energy rates that are a little lower, but we might have a tax liability that's going to be a lot higher. What we try to do is we try to use the incentives and the exemptions to kind of rectify that as much as possible across the tax costs that are there. So that in theory, if you are more competitive, if you make changes to the tax structure and reduce the liability and the burden and level that playing field, there's going to be less of a need for the income tax incentives or the sales tax incentives or the economic development incentive programs. And I think we've seen a little bit of this with what the legislature has done in regard to the sales tax. Years ago, we were fully taxing energy consumed in manufacturing and repair and replacement parts, and gradually we have reduced the burden of that particular tax. Correspondingly, the legislature passed a law in 2017 to sunset the InvestStart program, which was an incentive program that we used partially to overcome our uncompetitive sales and use tax rates. So I think this is a good example of how this equation was balanced out by the legislature. By reducing the tax burden in one area, you can reduce the amount of the incentives in the other. I think that's a good model to follow that we basically in support of across all of the tax issues.
Have these tax changes been in effect long enough in these states that you mentioned that they would have an information to, any way of providing us information to show whether or not there's been this trade-off of, because we have lowered the taxes, we're not on the hook so much for these incentives. So I know they can be targeted, that makes sense. But anything they could tell us probably, do you think?
The states that I provided to you here have just recently done this, so I would say the jury's probably still out. There is some caution, though, that some states like Kansas went through a comprehensive review of theirs and made some pretty big cuts, and I understand there's revenue shortfalls. Some of the other states that have had revenue shortfalls that have been affected and have affected economic development in the past years have been Missouri and Oklahoma also, to where they were actually going to a moratorium on their incentive programs because of the downturn in the budget. How much of that was policy related versus just the economic downturn and circumstances beyond their control, I don't know. But from what I've read from the other states and why they were doing this, it's to increase business development and encourage business growth. And states like Michigan and Ohio have seen business growth. Now, what that translates to the actual state budget, I do not have any of that data and do not make an assumption.
Thank you. Thanks, Mr. Chairman.
Thank you, Senator. Representative Dotson, you're recognized.
Thank you, Mr. Chair. You made a statement a little bit earlier with regards to when various industries and corporations are looking at investing in Arkansas, the income tax rate is one of the first things they see, and they do a comparison across various states. What are the other states that we're compared up against oftentimes, or we're competing against, they look at that and are the ones we have to try to overcome that particular red flag in the eyes of folks that might be out there looking at it and not even ask us the question?
Back in 2002 and 2006, for those of you who may remember, it's been a long time, there was a similar process like this that the legislature went through, and a consulting firm by the name of Fleur Consulting was asked to do that very thing, to look at Arkansas and competitor states with our tax structure and also with our business incentive programs. The states that we were compared to were our contiguous states and states east and to the southeast of us, ranging all the way from North Carolina down to Florida and then over to Texas and Oklahoma. To this day, we still use those states for the comparative data that we put together. Those are the core ones that we do compete against. In today's global economy, though, we really compete against not only states, but countries, and their tax rates are even crazier than some of the other states that we're up against. But a lot of the projects that we compete in that are core projects would be Alabama, Mississippi, Georgia. To some extent, we've competed against western states like Arizona and California, most certainly Texas and Tennessee, because they're right next to it. A lot of the business costs, a lot of the taxes, they will look at and make those comparisons.
So I guess more to the heart of it, when when you're looking at those contiguous states or the ones you just mentioned, how does the ranking compare with those? If somebody's just doing an initial overview and then, because oftentimes, you know, as any sales pitch out there, you've got your 30-second elevator pitch and then you're out off the list and they never consider us again.
Well, my 30-second pitch on this would be corporate income tax. We're in the middle of the pack. We rank anywhere from 21st to 39th. Most of the states around us have a more advantageous corporate income tax structure, with the exception of Louisiana. Sales and use tax were towards the bottom, because when you add the state sales tax and the local tax, we're at a lot of times the 10% range. So we rank very poorly, probably lower 40s and sometimes the mid 40s. Workers' comp, we rank very favorably in. I'd say we're in the top 3 in workers' comp rates. Unemployment insurance, we just recently had the taxable wage base go up from 10 to 12, which made us a little less competitive. But overall, we're about the middle of the pack on that. Labor costs, we're, depending on the type of labor, we're very competitive with most states. Energy costs, things like electricity, we usually rank in about the top 10. Let's see, what else would be up there? Transportation costs, really depends on the type of industry and the freight being moved. So when you look at these, you see rankings everywhere from labor cost being number 1 and sales and use tax somewhere in the upper 40s. So we're kind of in the middle of the pack, so to speak, on all of the factors. And that's where the juggling act really begins.
Follow up, Mr. Chairman. So if you were to pick all the ones you just mentioned, what would be the key areas of focus that you would it be the sales and use tax, or would it be the corporate income tax? Which one, if you were making that sales pitch, as you do every day, choose Arkansas or someplace else, would you say, this is the one where people would perk up and try to get us from 45th to 25th or below?
That's a difficult question, because I think both really need work, to be honest with you. Our upper rate for the sales and use tax is high, as is our corporate rate, both high. So if you look at just the upper rates of those taxes and try to bring those down, that would help on both accounts. It seems like there's more moving parts involved in the corporate income tax, so I would think that would need a little bit more work, a little bit more dynamic scoring and running through the options, because so many things that you do affect whether or not something is going to be taxed for income. Sales are a little bit more clear-cut on that. Plus the fact that we have made some progress of late with some of the sales and use tax cuts that have occurred. Again, it would be really hard. I think both are really issues that we need to take a close look at competitively for that. As far as those reports that I referenced in 2002, 2006, most of the weaknesses that were pointed out were in the sales tax realm.
And then that's the area we've been making
We've been
a little bit of progress.
Yes.
Thank you, Mr. Chairman.
Thank you. Any other questions? D, F, and A, are y'all through? Okay. We have nobody signed up. Anybody in the audience want to speak on this? Representative Dotson and Senator Representative Kavanaugh, y'all, this is y'all's issue. Would one of y'all make a motion to further study this? You're recognized, Representative Dotson.
Or, I think I would make a motion on, what was it, proposal number 10?
It'll be items 9 and 10.
9 and 10. Well, I guess
I would work with BLR staff for further refining.
yeah, I'll make a motion to be allowed to work with the other staff to further refine items 9 and 10 for inclusion in the final packet.
Okay, we have a motion and a second. With a second, Kavanaugh, any discussion? All in favor say aye. Aye. Any opposed? All right, we're going to move on to item 11, which is Representative Dotson, to review the process of personal income tax. Ms. Leonard, you're up again.
Thank you, Mr. Chair. This is the only proposal I just, so it'll just be proposal number 11, and that is to create a systematic review process for personal and corporate income tax exemptions, so those will be reviewed on a regular basis. the FAA stated that the fiscal analysis of this proposal would depend on the specifics in terms of the amount of administrative implementation required and any third-party expenditures that would be required. Arkansas currently does not have a required systematic review of personal and corporate income tax exemptions. However, we do a cost-benefit analysis of projects that are provided in incentive under the Consolidated Incentive Act of 2003, which does include some income tax incentives. In terms of other states, the other states that we looked at have some sort of review of their tax expenditures. Iowa has a legislative committee that they created to review all tax credits, exemptions, deductions, and rebates on a 5-year rotating basis, so that each year the committee is reviewing a different group of tax expenditures, and that just, each group comes up every 5 years. They look at those and consider the equity of the expenditure, the simplicity, the competitiveness, the public purpose, the adequacy, and whether or not it conforms with the original intent of the tax expenditure. They also report on the return on investment for each of those. Louisiana's Department of Revenue is required to complete an annual tax exemption budget that looks at each exemption, exclusion, deduction, credit, special rate, and deferred liability. And they're looking at whether it has been successful in meeting its purpose, whether it is the most fiscally effective means of meeting that purpose, whether the exemption has any unintended consequences, and whether the exemption simplifies or complicates the tax law. They also look at the revenue loss that results from each exemption for the previous 3 fiscal years, and then the estimated revenue loss for the current fiscal year and the next fiscal year. Now, in addition to that, then the House and Senate committees are required to conduct meetings in odd number of years to analyze that report, especially for those exemptions that have a revenue loss of at least $10 million in any of the last 3 fiscal years. In addition to that, each state agency that oversees a tax exemption is required to submit a report in each even numbered year concerning whether the tax exemption has been successful in meeting its purpose. And then the House and Senate committees meet on those reports to discuss those issues. Beginning in 2020, the Department of Revenue will also be required to perform a comprehensive return on investment analysis for each tax exemption that had a revenue loss of at least at least $1 million in the previous fiscal year. Mississippi requires their University Research Center to submit an annual report detailing the costs of revenue for each tax expenditure, the policy purpose, and any indicators of effectiveness or ineffectiveness in achieving the policy purposes. They also allow kind of out if doing this report creates kind of a burden on the University Research Center in terms of getting their other work done, then they can limit it to just the cost for each expenditure. Missouri's Office of Administration also does an annual tax expenditure budget that includes the reduction in revenues for each fiscal year as a result of each of those tax expenditures. And they periodically require a cost-benefit analysis for certain tax incentive programs along with that. And in addition, each state agency that offers a tax expenditure is required to submit an annual report on the amount of the expenditure for the next fiscal year and a cost-benefit analysis of each expenditure for the previous fiscal year. Missouri also prohibits the issuance or certification of a new tax credit unless an estimate of the credit has been reviewed and approved by a majority of the Senate Appropriations Committee and the House Budget Committee. Oklahoma's Tax Commission in each even-numbered year submits a report on all of their tax exclusions, deductions, credits, exemptions, deferrals, and preferential tax treatment. That includes an estimate of the amount of revenue loss as a result of each of those tax expenditures. Tennessee has their Commissioner of Economic and Community Development and Commissioner of Revenue work together to review the franchise and excise tax credits for the previous 4 fiscal years, and they report on the purpose of each credit, the revenue lost as a result of each credit, any benefits to the state from the credits, and then the estimated indirect economic impact of each of the credits. Then they prepare a report of their findings and recommendations on their analysis. They do that every 4 years, and then they also require that the Commissioner of Revenue study and report on the tax laws of other states. They go beyond reviewing theirs and they look at what other states are doing as well. And in Texas, before each regular session, the comptroller has to report on the effect of their tax expenditures related to the franchise tax And that is required to include an analysis of each one that reduces the amount of tax payable, including an estimate of the lost revenue for a 6-year period. And then for any provision that results in, for any provision that reduces the revenue by more than 1% of the total revenue for that type of tax, they have to include the effect on the distribution of the tax burden by income class and by industry or business class. That report may also include an assessment of the intended purpose of each tax provision, whether that purpose is being met, and any recommendation that they would have for retaining, eliminating, or amending that tax provision.
Senator Henry, you recognize.
Yeah, thank you, Mr. Co-Chair. I think, members, this is almost identical to what we did on the sales tax exemption. We adopted a recommendation that we find a periodic review process and develop that and put it in place. In fact, that wasn't something that was put for study. It was just a recommendation that was made and approved. And I think we can do a similar thing with this, because I think all of us have learned that we need to put in place Iowa. It's like I said, it's a very good process, but we can develop that process later. But for our report in September, I think if this is a recommendation that we agree with, then I think this is Representative Dotson's motion. If he would make a motion that we just do that, we can go ahead and make a recommendation. And I think for timing purpose, and I talked to staff about this yesterday, while our report is due in September, we will continue to meet from September through December, taking items like this and developing it into legislation. So that'd be the time at which you decide, is it going to be a 5-year rotating process, or how it's going to be structured exactly. But anyway, that'd be my thought on one of this that I think we all see the need for, and we don't really need to continue to mull it over. It's just adopted as a recommendation. That's what the Representative Dotson wants to do.
Representative Dotson, you have a question, or are you ready for a motion?
Motion.
All right, let's see, anybody else wants to speak on this? There's no fiscal impact. DFA, local work.
Mr. Chair, certainly when it comes to determining what the needs would be to perform the specific requirements of any potential legislation, we would just need to make a determination of what additional resources in terms of additional staffing would be required to meet the needs of the reporting.
Okay. Take a motion.
I move that we be allowed to work with BLR staff and I suppose the to further refine this and get this into the
Do we have a
recommendation.
second? Do we have a second? Any discussion? All in favor say aye. Any opposed? All right, members. We're going to move on to items 12 and 13. We'll combine those. Ms. Leonard, you're up.
Proposal 1213 deal with the earned income tax credit. Now, we talked about this last month, so I'll keep it as brief as possible. Arkansas does not currently have an earned income tax credit. The federal EITC is a refundable credit that varies based on the amount of income that the taxpayer has and the number of qualifying children. It is available only to taxpayers who have earned income and adjusted gross income below a certain level. You can see the table on the proposals that is used in determining the EITC for the 2018 tax year. That you can see the maximum amount of credit for someone with 0 children is $519, up to a maximum credit of someone with 3 or more children of $6,431. Only 3 of the states that we looked at have an EITC. Iowa has a refundable credit as equal to 15% of the federal EITC. Louisiana has a refundable credit that is equal to 3.5% of the federal EITC. And Oklahoma has a